We've just updated our latest mortgage stress and default modelling to January 2018. So today we discuss the results and count down the latest top 10 most stressed suburbs across Australia. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Today we discuss the latest mortgage stress and default results and count down to the current most highly stressed postcodes in the country. This is based on our updated mortgage stress and default modelling for Australian mortgage borrowers to the end of January 2018. Our analysis uses the DFA core market model, which combines information from our 52,000 household surveys, public data from the RBA, ABS and APRA, and private data from lenders and aggregators. The data is current to the end of January 2018. We analyse household cash flow based on real incomes, outgoings and mortgage repayments, rather than an arbitrary 30% of income. Households are defined as stressed when net income does not cover ongoing costs. And households in mild stress have little leeway in their cash flows, whereas those in severe stress are unable to meet repayments from current income. In both cases, households manage this deficit by cutting back on spending, putting more on credit cards, and seek to refinance, restructure, or sell their home. Across Australia, more than 924,000 households are now estimated to be in mortgage stress, compared with 921,000 last month. This equates to 29.8% of households. In addition, more than 20,000 of these are in severe stress, which is down 4,000 from last month. And we estimate that more than 51,500 households risk 30-day default in the next 12 months, which is 500 down from last month. We expect bank portfolio losses to be around 2.7 basis points, though losses in WA are likely to rise to 4.9 basis points. Some households have benefited from refinancing to cheaper owner-occupied loans, giving them a little more wriggle room in terms of cash flow. The typical transaction has saved up to 45 basis points or $187 each month on a $500,000 repayment mortgage. As continued pressure from low wage growth and rising cost bites, those with larger mortgages are having more difficulty balancing the family budget. As a result, risks in the system continue to rise. And while recent strengthening of lending standards will help protect some new borrowers, there are many households currently holding loans which will not now be approved. These stressed households are less likely to spend at the shops, which will act as a further drag anchor on future growth. One reason why retail spending is muted. The number of households impacted are economically significant, especially as household debt continues to climb to new record levels. Indeed, mortgage lending is still growing at 3 times income, and this isn't sustainable. The latest household debt to income ratio from the RBA is now at an astronomical record 199.7 and will likely break above 200 in the month ahead. The forces which are lifting mortgage stress remain largely the same. In cash flow terms, we see households having to cope with rising living costs, noticeably childcare, school fees and fuel, whilst rental incomes continue to fall and underemployment remains high. Households have larger mortgages thanks to the strong rise in home prices, especially in the main eastern state centres. While mortgage rates remain quite low for owner-occupied borrowers, those with interest-only loans or investment loans have seen significant rises. We expect some upward pressure on real mortgage rates in the next year as international funding pressures mount, potentially a local rate rise and margin pressure on the banks. The recently passed US tax reforms are likely to put more upward pressure on rates. Our probability of default modelling extends our mortgage stress analysis by overlaying economic indicators such as employment, future wage growth and CPI changes. We've also extended our core market model to examine the potential of 90-day defaults and portfolio risk of loss in basis points and value terms. Losses in value terms are likely to be higher from more affluent households. Regional analysis shows that New South Wales has 254,000 households in stress, down from 258,000 last month. Victoria 254,000, similar to last month. Queensland 158,000 compared with 156,000 last month, and WA 125,000 compared with 122,000 last month. The probability of default rose, with around 9,800 in WA, around 9,500 in Queensland, 13,000 in Victoria and 14,000 in New South Wales. The largest financial losses relating to bank write-offs reside in New South Wales at $1.3 billion from owner-occupied borrowers and from Victoria at $910 million from owner-occupied borrowers, which equates to 2.07 and 2.74 basis points respectively. Losses are likely to be highest in Western Australia at 4.9 basis points, which equates to $753 million from owner-occupied borrowers. So now, let's look at the top 10 highest postcodes in mortgage stress across the country. As normal, there are some changes from last month, as conditions vary across the states. But overall, we see relatively more stress in Queensland, Victoria and New South Wales. We're going to count down to the postcode with the highest levels of mortgage stress this month. But we start in 10th place with Victorian postcode 3037, down from 7th place last month, which includes areas around Delahaye, Hillside and Sydenham, around 20 kilometres northwest of Melbourne. Here, around 4,398 households are in mortgage stress. Of the 13,000 households in the district, more than half have a mortgage, and the average age is 33 years. The average home price is around $570,000, up from $365,000 in 2010. The average monthly income is around $7,200 and the average mortgage repayment is $1,730. In 9th place, and down from 5th place last month, is Queensland postcode 4350, around Drayton and Toowoomba and around 100 kilometres from Brisbane. We estimate 4,398 households are in mortgage stress. The average home price is $495,000 compared with $382,000 in 2010. There are around 27 households in the region and the average age is 37 years. The average income is $5,300 a month and around 30% have a mortgage, and the average mortgage repayment is $1,510 a month, which is 28% of average incomes. In 8th place, and down from 6th place last month, is Victorian postcode 3350, which includes Ballarat and the surrounding areas. It's around 100 kilometres from Melbourne. In this region, there are 4,399 households in mortgage stress. The average property value is $335,000 compared with $305,000 in 2010. There are more than 14,500 families in the area and the average age is 37 years, line ball with the average across the state. The average monthly income is $5,300, well below the national and state averages. Around 33% of households have a mortgage and the average repayment is $1,408 a month. 7th, and back in the top 10 list, is another Victorian suburb, 3806 Berwick and Harkaway, which is around 40 kilometres southeast of Melbourne, with 4,827 households in mortgage stress. The average home price is $625,000 compared with $451,000 in 2010. There are around 13,000 families in the area with an average age of 36 years. More than 47% of households here have a mortgage and the average repayment is $1,850 a month compared with the average income of $7,600 a month. Back in the list, in 6th position, we go to WA to 6030, which includes Clarkson, Merriwa and Tillama Park, 34 kilometres north of Perth on the coastal strip. There are around 11,000 households there, the average age is 34 years, and more than half have a mortgage. The average home price is $400,000, down from $416,000 in 2010. We estimate that there are 5,176 households in mortgage stress. The average income is around $7,000 a month, above the national average, but the average mortgage repayment is also over $2,000 a month, well above the national average. In fifth place, and down from second place last month, is the Victorian postcode 3805, which includes Narre Warren and Fountain Gate. This area is around 38 kilometres southeast of Melbourne. Here, 5,698 households are in mortgage stress. The average home price is $588,000 compared with $366,000 in 2010. There are more than 15,000 families in the area and the average age is 34 years. The average household income is just over $7,000 a month, which is higher than the national average. 54% of homes are mortgaged and the average monthly repayment is $1,700, slightly below the national average of $1,755 a month. In fourth again this month is the area around Campbelltown in New South Wales, 2560, which is around 43 kilometres inland from Sydney. Here, 6,145 households are in mortgage stress. The average home price is $646,000, up from $320,000 in 2010. Around 20,000 households live in the area with the average age of 34 years. The average income is $6,100 a month and 37% have a mortgage, and the average repayment is higher than national average at $1,800 a month and equates to 29.5% of average incomes. In third place again, we cross the Nullarbor to WA to 6065. This is the area around Wanneroo, including Tapping, Hocking and Lansdale, and is located around 25 kilometres north of Perth. It's an area of high population growth and residential construction, mainly on smallish lots. There are more than 6,115 households in mortgage stress in the region. The average home price is $421,000, compared with $402,000 in 2010 and down from a peak of $490,000 in 2014. There are around 17,000 households in the district with the average age of 33 years. The average income is $8,300 a month and 58% have a mortgage with an average repayment of $2,170 a month, well above the Western Australian and national averages. In second place and back in the top 10 we go to Queensland to 4350 around Drayton and Toowoomba, about 100 kilometres from Brisbane. We estimate that there 6,325 households are in mortgage stress. The average home price is $490,000 compared with $382,000 in 2010. There are around 27,000 households in the region and the average age is 37 years. The average income is $5,300 a month. Around 30% have a mortgage and the average mortgage repayment is $1,510 a month. But the postcode with the highest count of stressed households, once again, is New South Wales postcode 2170, the area around Liverpool, Warwick Farm and Chipping Norton. It's about 27 kilometres west of Sydney. There are 7,375 households in mortgage stress in the area, up by more than 1,000 compared with last month. The average home price is $815,000 compared with $385,000 in 2010. There are around 27,000 families in the area with an average age of 34 years. The average income is $5,950 a month. 36% have a mortgage and the average repayment is around $2,000 each month, which is more than 33% of average incomes. We continue to see mortgage stress still strongly associated with fast-growing suburbs where households have bought property relatively recently, often on the urban fringe. The ranges of income and property prices vary, but note that it is not necessarily those on the lowest incomes who are the most stretched. Banks have been more willing to lend to these perceived lower risk households, but the leverage effect of larger mortgages has a significant impact and the risks are underestimated in our view. We will continue to monitor mortgage stress and will update our core market model again next month. Finally, I think it's worth repeating that many households in stress do not have a robust household budget, and creating one is an important first step to getting to grips with stress. Whilst putting more on credit cards and refinancing may superficially seem attractive mitigation steps, our analysis shows that these are often only temporary fixes. Getting to grips with where the money is going is an important first step to tackling the problem. Remember too that banks have an obligation to assist in cases of hardship. So, if you are a household in difficulty, talk to your lender, rather than just hoping things will work out. Given flat incomes and rising prices, this is unlikely. You may also want to watch our recent video blog on Should I Buy Now, where we discuss this in more detail. If you found this useful, do leave a comment below or subscribe to receive future updates. You can also read much more about the mortgage stress footprint on our blog. I'm Martin North, Principal Analyst at Digital Finance Analytics. Many thanks for taking the time to watch.